Most people believe that banks simply make money by lending out deposits and charging interest. However, the reality is far more complex and often misunderstood. Behind the polished facades and familiar logos, banks operate using mechanisms that are rarely discussed outside financial circles. In this section, we'll begin to unravel the hidden truths about how banks truly generate profit. By challenging conventional wisdom, we set the stage for a deeper exploration into the central mystery. What really happens to your money once it enters the banking system? The story of money begins with simple barter systems, where people exchanged goods and services directly. As societies grew more complex, the limitations of barter became clear, prompting the search for more efficient means of trade. Early civilizations adopted items like shells, metal coins, and other objects as standardized currencies. Over time, gold and silver became widely accepted due to their durability and intrinsic value. In medieval Europe, goldsmiths played a pivotal role by storing precious metals for safekeeping and issuing paper receipts as proof of deposit. These receipts gradually evolved into a form of money themselves, laying the foundation for modern banking and the creation of currency backed not by physical commodities, but by trust and promise. The emergence of modern banking transformed the way societies manage and grow their wealth. Central to this evolution is the concept of fractional reserve banking, a system in which banks are required to keep only a fraction of their deposits in reserve while lending out the remainder. This process allows banks to effectively multiply the amount of money circulating in the economy. When a bank issues a loan, the recipient deposits the funds into another bank, which in turn lends out a portion of that deposit. Through repeated cycles of lending and depositing, the initial sum grows, expanding the money supply far beyond the original deposits. This mechanism has played a crucial role in fueling economic growth, but it also introduces risks, such as the potential for bank runs if too many depositors demand their money at once. Banks employ a variety of strategies to generate revenue. One of the primary sources is the interest earned on loans, which includes mortgages, personal loans, and business financing. In addition, banks collect fees for services such as account maintenance, overdrafts, and wire transfers. Card commissions arising from credit and debit card transactions also contribute significantly to their income. Some banks sell debt, transferring risky or non-performing loans to other financial entities for a price. Finally, aggressive investing in stocks, bonds, and other financial instruments allows banks to seek higher returns, though this approach carries greater risk. Together, these methods form the backbone of a bank's financial operations. Banks operate by accepting deposits from customers and then lending out a portion of these funds to borrowers. The interest charged on these loans is higher than the interest paid to depositors, creating a profit margin for the bank. Through a process known as fractional reserve banking, banks are able to lend out much more money than they actually hold in reserves. This multiplies the amount of money circulating in the economy and increases the bank's earning potential. The difference between the interest rates, what the bank pays to depositors, and what it receives from borrowers, is a key source of income for financial institutions. Over time, this system enables banks to grow their assets and maintain profitability. Banks impose a variety of fees on their customers, ranging from monthly account maintenance charges to overdraft and ATM fees. These costs can quickly add up, especially for individuals who rely on basic banking services. Lower-income customers are often hit hardest, as they may be more likely to incur overdraft fees or fall below minimum balance requirements. For many banks, these fees represent a significant portion of their revenue, sometimes even surpassing earnings from traditional lending activities. The reliance on fee income has sparked ongoing debates about fairness and accessibility within the financial system. As a result, some advocates call for reforms to reduce the burden on those least able to afford it. Understanding the structure and impact of bank fees is crucial for both consumers and policymakers. Interchange fees are charges that banks collect each time a customer uses a credit or debit card for a transaction. These fees are paid by the merchant's bank to the cardholder's bank, allowing financial institutions to earn a small profit from every card purchase. As more consumers opt for card payments over cash, banks benefit from a steady stream of interchange revenue. This financial incentive encourages banks to promote digital payment methods and support the transition toward a cashless economy. The widespread adoption of cards not only streamlines transactions, but also increases the profitability of banks through these fees. Ultimately, interchange fees play a significant role in shaping payment trends and the broader financial landscape. Banks often bundle unpaid consumer debts, such as credit card balances or personal loans, and sell them to third-party debt collectors. These debts are typically sold for a fraction of their original value, allowing banks to recover some losses quickly. For debt collectors, these purchases represent an opportunity to profit by collecting more than they paid for the debt. This process effectively transforms individual financial hardships into tradable assets within the financial industry. As a result, personal debts can change hands multiple times, each transaction driven by the potential for profit. The system underscores how financial institutions monetize consumer struggles, turning private challenges into commodities on the open market. Banks play a crucial role in the financial system by accepting customer deposits and using these funds to invest and trade in various markets. While savers typically receive modest interest rates on their deposits, banks are able to generate much higher returns by lending money at higher rates, purchasing securities, and engaging in other financial activities. This difference between the interest paid to depositors and the returns earned from investments is a key source of profit for banks. By leveraging large pools of customer funds, banks can participate in lucrative opportunities that are often inaccessible to individual savers. As a result, the gap between what banks earn and what they pay out highlights the importance of understanding how financial institutions operate behind the scenes. The banking system is designed in a way that often encourages financial dependency among consumers. Banks profit significantly from lending, which creates strong incentives to promote debt through credit cards, loans, and mortgages. This structure means that individuals are frequently offered easy access to borrowed money, sometimes without fully understanding the long-term consequences. As people take on more debt, they become reliant on the banking system to manage repayments and maintain their financial stability. High interest rates and complex fee structures can make it difficult for consumers to escape this cycle. Ultimately, the system benefits from keeping individuals in a state of ongoing financial obligation, which can limit their ability to build true wealth and independence. Debt products, such as loans, credit cards, and mortgages, are a primary source of profit for banks. By lending money at interest, banks generate steady revenue streams that underpin their financial stability. The system is designed to encourage borrowing, often making credit easily accessible to individuals and businesses. This widespread availability of debt can lead to increased financial vulnerability, as borrowers may struggle to manage repayments or face unexpected changes in their circumstances. As people take on more debt, banks benefit from the interest payments, reinforcing the cycle of borrowing. Over time, this dynamic can contribute to broader economic risks, especially if large numbers of borrowers become unable to meet their obligations. Banks play a crucial role in the creation of money through lending. When a bank issues a loan, it effectively generates new money by crediting the borrower's account, increasing the overall money supply in the economy. As more money circulates, the demand for goods and services can rise, which may lead to higher prices, a phenomenon known as inflation. Inflation reduces the value of each unit of currency, meaning individuals can buy less with the same amount of money. Over time, this erosion of purchasing power impacts households, making everyday expenses more costly. The relationship between bank-created money and inflation is complex, but it highlights how financial systems directly influence the economic well-being of individuals. Many consumers believe that simply saving money in a bank account is a safe way to preserve their wealth. However, when interest rates are low, the returns on these savings often fail to keep pace with inflation. Over time, this means that the actual purchasing power of the money saved steadily declines. This phenomenon is known as the savings trap, where the combination of low interest and rising prices erodes the real value of savings. Even though the account balance may grow slightly, its ability to buy goods and services diminishes. Understanding this dynamic is crucial for making informed financial decisions. Many homebuyers believe that purchasing a house with a mortgage means they will soon own their property outright. However, the reality is more complex. Over the life of a typical mortgage, buyers often pay significantly more than the original price of the home, largely due to accumulated interest. This means that the total cost can far exceed the house's market value. Meanwhile, until the mortgage is fully paid off, the bank retains legal ownership of the property. If payments are missed, the bank has the right to reclaim the home. This system highlights how the illusion of ownership can mask the true financial dynamics at play. Certain banking products, such as payday loans and reverse mortgages, are often marketed to individuals facing financial hardship. Payday loans promise quick cash, but come with extremely high interest rates and fees, making it difficult for borrowers to repay the full amount. This can lead to a cycle of debt, where consumers must take out new loans just to cover previous ones. Reverse mortgages, while offering access to home equity for seniors, can also carry hidden costs and complex terms that may erode long-term financial security. These products are frequently criticized for targeting vulnerable populations, ultimately trapping them in ongoing repayment obligations. Understanding the risks associated with these financial tools is crucial for making informed decisions and avoiding exploitative practices. Throughout history, banking crises have often been triggered by an over-reliance on borrowing within the financial system. When banks lend excessively and take on too much risk, they become vulnerable to sudden shifts in economic conditions. As these institutions struggle to repay their own debts, panic can spread, leading to widespread collapses. The fallout is rarely confined to the banks themselves. Ordinary people frequently suffer the most, facing job losses, diminished savings, and reduced access to credit. These events highlight the interconnectedness of financial institutions and the broader economy. Ultimately, systemic dependence on borrowing not only destabilizes banks, but also undermines the financial security of entire communities. Modern banking has evolved into a highly aggressive industry, leveraging technology and sophisticated strategies to influence consumer behavior. Digital payments have made transactions faster and more convenient, but they also encourage frequent spending and reduce awareness of financial outflows. Credit scores now play a pivotal role in determining access to loans and services, often pressuring individuals to maintain certain financial habits. Hidden charges, embedded in complex fee structures, can erode account balances without clear disclosure. Additionally, psychological tactics, such as targeted marketing and reward systems, are designed to foster loyalty and drive usage, sometimes at the expense of consumer well-being. Together, these factors contribute to increased vulnerability, making it essential for consumers to remain vigilant and informed in their financial decisions. Digital payments have transformed the way people manage their finances, offering convenience and speed in daily transactions. However, this shift has also made it easier to overlook the small fees and hidden charges that can accumulate over time. Credit scores now play a crucial role in determining access to loans, housing, and even employment opportunities, making financial decisions more consequential than ever. Many individuals find themselves navigating complex terms and conditions, often unaware of how certain actions might affect their credit standing. The prevalence of hidden charges in subscriptions, banking, and online purchases can erode savings without notice. As financial systems become more interconnected and automated, understanding these factors is essential for maintaining control over personal finances. Ultimately, staying informed and vigilant is key to avoiding unnecessary costs and protecting one's financial health. In recent years, psychological banking has emerged as a powerful strategy within the financial sector. Banks are increasingly leveraging insights from behavioral science to influence customer decisions and drive profitability. By understanding patterns such as impulsive spending, loss aversion, and the tendency to avoid complex choices, financial institutions design products and services that subtly encourage certain behaviors. For example, features like automatic savings prompts or reward-based credit cards tap into consumers' desire for instant gratification. While these tactics can help customers manage their finances, they also serve to maximize profits for the banks. The rise of psychological banking raises important questions about ethics and transparency in the industry. Protecting yourself financially begins with understanding how banks operate and recognizing the tactics they use to encourage borrowing. By becoming aware of these strategies, you can make more informed decisions and avoid unnecessary debt. Transitioning from a mindset of borrowing to one focused on ownership empowers you to build assets rather than liabilities. This shift not only strengthens your financial position, but also reduces long-term risks. Building financial resilience involves setting aside emergency funds, diversifying income sources, and consistently educating yourself about personal finance. These actionable steps can help you safeguard your future and achieve greater financial independence. Financial literacy is a crucial skill in today's complex economic landscape. Understanding how money works empowers individuals to make informed decisions and avoid common pitfalls. By staying vigilant and aware of banking practices, you can protect your assets and maximize your financial opportunities. Taking control of your finances means actively managing your budget, investments, and savings. With the right knowledge, you can outsmart the banking system and ensure your financial well-being. Remember, the more you know, the better equipped you are to navigate challenges and secure your future. As we reach the end of our exploration, it's important to remember that banks are not just places to store money. They are powerful institutions with their own interests. Understanding how banks operate can help you avoid common pitfalls and make smarter decisions about your finances. Staying informed is your best defense against unexpected fees, unfavorable terms, and financial setbacks. By taking an active role in managing your money, you can safeguard your future and achieve greater financial security. The more you know, the better equipped you are to navigate the complex world of banking.